At this point, we are all familiar with the saga that has surrounded GameStop, particularly the company's stock, after decreasing for years under the pretense that the company was destined for failure as the habits of its customers changed from purchasing their games at physical retail locations to downloading and purchasing games directly via digital stores, whether consoles or PCs, leaving GameStop to confront the same fate of fellow retailers such as JCPenney, Neiman Marcus, and Toys R Us. But there was an opposing narrative, one which reflected the potential of GameStop to transition into an online gaming retailer that could serve the evolving behaviors of its customers. And with a successful entrepreneur like Ryan Cohen, the founder of Chewy, backing the company, there developed significant credence to this prospect. Along the way, a cast of characters emerged, from the institutional side with hedge funds or the purported masters of the universe, to retail investors, who definitely aren't cats, by the way.
I'm not a cat.
But this story is articulated ad nauseum already, so that's not the purpose of this video. What is a bit more obscure though, is the actual company itself. The companies whose public stock is supposed to, at least ultimately, represent the value, potential, or lack thereof of the operating company. So how large is GameStop today, and what does the company potentially look like going forward? To understand the current size of GameStop and the potential paths of the company going forward, an understanding of its origins is necessary. Founded in Dallas, Texas in 1984 as Babbage's by Harvard Business School classmates James McCurry and Gary M. Cusson, the original concept of the store was that of a software retailer. At this time, it seemed appropriate to focus on this area as it coincided with the emergence of the personal computer. With the notable release of the Macintosh, the era of personal software was unleashed. The two founders, McCurry and Cusson, set out to raise capital in order to capitalize on the burgeoning industry. Eventually, the company was able to attain funding from the iconoclastic businessman Ross Perot. After establishing the initial store, they quickly pivoted to selling games, with the company going public in 1988, only 4 years after its founding. From this point, the company merges and expands rapidly through a series of acquisitions that led to Babbage eventually becoming the GameStop we're familiar with today. There could be a separate video detailing these acquisitions and mergers, but here are the basics. In 1994, Babbage's merged with Software Etc. to form Neostar Retail Group, a holding company which allowed the two companies to operate as independent subsidiaries of Neostar. Eventually, Neostar merged its two units, Babbage's and Software Etc., into a single organization, amid declining sales, dissolving the independence of the two subsidiaries. After 2 years, Neostar filed for Chapter 11 bankruptcy, with the company's assets being purchased for $58.5 million by Leonardo Riggio, a prominent businessman who happened to be the chairman and principal share owner of Barnes & Noble. In fact, Barnes & Noble exhibited interest in the bankrupted Neostar, which foreshadows a future relationship between the eventual GameStop and Barnes & Noble. In 1996, the company, now out of bankruptcy, with the new owner, dissolved the holding company and created a new company called Babbage's Etc. 3 years into its operation, under the new owner, the GameStop brand officially launched in 1999. Not only did GameStop launch in physical retail locations during this period, it also capitalized on the rising popularity of the internet by launching GameStop.com, a website allowing people to purchase video games online, and an asset that's critical to the future of GameStop, but more on that later. The period of 1999 to 2004 was transformational for GameStop, which began to resemble the entity recognized by many today. In 1999, Barnes & Noble acquired Babbage's Etc. for $215 million. This is after Leonardo Riggio purchased the assets that eventually became GameStop for $58.5 million. And as mentioned, he's the principal share owner of Barnes & Noble. After this acquisition, Barnes & Noble purchased the Minnesota video game retailer Funko for $160 million in 2000. Barnes & Noble went on to acquire another video game related property, this time in the magazine industry, by purchasing Game Informer. Soon after these acquisitions, Funko and GameStop operated as one entity under the GameStop brand. Culminating these series of acquisitions and mergers was the 2002 initial public offering of GameStop on the New York Stock Exchange, trading under the ticker symbol GME. 2 years later, in 2004, GameStop was a fully independent company after Barnes & Noble distributed its remaining ownership stake to shareholders. 1 year later, in 2005, GameStop and EB Games merged, providing GameStop with significant international exposure. From 1998 to 2011, GameStop was able to grow revenue every year until fiscal 2012, which marked the first year-over-year decline in sales. Although this specific decline was attributed to the late console cycle and subsequent limited new video game releases for the aging PlayStation 3 and Xbox 360 consoles. In 2013, with the new generation consoles release, consisting of the PlayStation 4 and Xbox One, the company reignited another string of sustained revenue growth until 2015. At this point, GameStop's business began to diverge from its historical growth path, and the company began experiencing anemic growth to outright declines between 2016 to 2019, from peak revenues of over $9.5 billion in 2011 to a bit over $6.4 billion in 2019, while net income fell from $339 million in 2011 to a loss of $470 million in 2019. The company is obviously experiencing headwinds that are diminishing the company's prospects. As GameStop experienced declining sales, it took to highlighting its focus on its core video game retail and collectibles business, while also focusing on investments made to develop its retail stores to become more experiential concepts. GameStop also underscored its investments in the ever-important area of e-commerce and digital distribution channels, as consumers increasingly come to favor the expediency of purchasing and playing games within minutes. For context of consumers' preference for digital and e-commerce channels, Sony's PlayStation Network, which includes digital games, DLC, and subscription services, earned over $12 billion in 2019, effectively double the total revenue of GameStop. Of that, over $9 billion was related directly to gaming content, meaning the purchase of full games, add-ons, and microtransactions. It's not entirely bad news for GameStop though, and there is evidence that they are cognizant of e-commerce and digital channels. In 2020, GameStop partnered with Microsoft, which would see the gaming retailer receiving a revenue cut of digital revenue from Xbox consoles sold at its stores. This includes all downstream revenue from digital downloads and digital content from any device that GameStop brings into the Xbox ecosystem. GameStop also experienced a 1,500% increase in online sales during parts of the pandemic as individuals flocked to its website to purchase consoles and games to placate themselves during quarantine. GameStop is not oblivious to the dynamics of its business and the possibility of it becoming another failed brick-and-mortar retail business, the likes of Blockbuster when Netflix and streaming services made its business model obsolete. As indicated by their investments in digital and e-commerce and their partnership with Microsoft to not only upgrade and standardize their retail stores using its dynamic 365 cloud offering, but also the digital revenue share agreement, GameStop appears to be venturing down the right path. But what about the future of GameStop? And can a successful entrepreneur that founded an online retailer for all items related to pets be the missing piece needed to turn around GameStop? On November 16, 2020, RC Ventures, a firm associated with the founder of Chewy, Ryan Cohen, published a missive directed to the board of directors of GameStop, expressing the urgency for the company to alter its strategy and to evolve into a technology company that delights gamers and delivers exceptional digital experiences, not remain a video game retailer that over-prioritizes its brick-and-mortar footprint and stumbles around the online ecosystem. In the letter, Cohen details the financial woes the company experienced even as the overall gaming industry expanded in size. He also opined on the decline in shareholder equity and seemingly abdication of the company's leadership to leverage its assets, such as its Power Up membership base, which includes some 42 million members, to seize digital trends. Cohen advocated for the company to close underperforming retail stores with an emphasis on European and Australian non-core operations. Further, he advocated for GameStop to use the increased cash flow from the recent iteration of the console cycle to make the necessary investments to reorient the company's top line toward a level of growth that is in line with industry growth rates. Cohen went on to accumulate an almost 13% stake in the company, with himself and 2 associates being appointed to the board, with an eventual committee established, which Cohen will lead, whose purpose is to effectively carry out the necessary changes required to transform GameStop into the technology-focused company Cohen outlined in his letter. Since the committee's development, changes in leadership have already taken place, with the hiring of an Amazon veteran as the company's new Chief Technology Officer. With the company's future in the hands of forward-looking entrepreneurs and activist investors, where does that leave GameStop? GameStop went from a software distributor to a gaming retail giant, booking over $9.5 billion in revenue at its peak. Today, the company's traditional retail business is at odds with the habits of consumers. In 2020, the video game industry earned $174.9 billion. Of that, only $14.9 billion was in physical sales. As the company contends with a valuation that shatters its previous market capitalization highs, the future of GameStop is dependent upon its ability to become the technology and e-commerce native company Cohen envisions. Maybe then, if this transformation is accomplished, the size of GameStop will transcend even its former zenith, capturing revenue, market share, profitability, and growth to satisfy its valuation. Thanks for watching. Until next time.